Hi! So I really just wanted to take the time to do a follow-up video on one of the biggest video that actually blew up on my video, where it has this thumbnail of me going all in on Alibaba when Alibaba was actually plummeting down. And to my disbelief, and of course to a lot of your disappointment, Alibaba is actually trading around $140 to $150 range in this week or so because of all the developments in China, especially the Evergrande thing. And honestly speaking, I really just wanted to take the time to address some of the concerns and some of the comments that was published on that particular video, and really to address some of the issues and really provide you with some of the context on why I did what I did, and to really just walk you through on what I've been doing when the dip just keeps dipping lower. So to just caveat this entire video, a lot of you out there have been constantly messaging me, DMing me on Discord, on Instagram, on whatever platforms out there, asking me, hey, this is my option strategy, should I do this, should I do that? Or hey, should I really buy the dip now? Is it gonna dip even lower? I just like to say that, and I would just like to qualify. I'm no fortune teller, and I honestly do not care about the short-term price movement. I'm still keeping my eyes on the price. I still have a long-term price target of Alibaba reaching $1,000 in 2030. Whatever Alibaba is gonna do in the short term, whether it's gonna dip to 100, 80, or even 50, I couldn't care less, because I'm probably gonna continue buying unless my fundamental thesis for Alibaba change, or the entire environment in China really warrants me to reevaluate my position and to reevaluate my exposure in China. But in particular, I can tell you, generally speaking, a lot of my fundamental analysis and a lot of my fundamental trajectory for how the company is progressing, on how the government is intentionally cracking down, on how the government is intentionally introducing draconian measures, and how they're going back to their communism roots. It's very far from my own version of truth. So for those of you who want to continue believing in those kind of rhetoric and narrative, please continue to do so. I'm not here to convince you otherwise. But anyway, just to provide you with a little bit of context, I'm actually 23 this year, and I do not have a full-time income because honestly, judging from how I look, I'm still a university student, and I still have 2 years before I actually graduate from university. With that in mind, knowing my current age and looking at my time horizon, speaking and viewing it from a probability lens, the current life expectancy in Singapore, which is the country I'm living in, is hovering at around 84 years old. So if you were to really just extrapolate back, I'm 23 this year, 23 to 84, I have around 60 years of time horizon, which is also why I've been constantly emphasizing on the point that, hey, I really do have the ability to take a very long-term horizon, because I really do have a shit ton of time. And for those of you who are currently professionals, for those of you who are working, and for those of you who are even nearing retirement, of course, different strategy works for different people. And I've only been updating you guys about my research, about my own analysis, and about what I've been doing while buying the dip. But honestly, your own financial position, your own financial circumstances, please go and find an advisor, or just read up more and just Google more. I'm really in no position to give you any forms of advice or dish out any form of constructive feedback for your circumstances, because I really do not know you enough. I do not know how much you have, I do not know how well prepared you are for retirement, I do not know your investment horizon, etc, etc. I really am living a very carefree life because number one, I'm still young, and number two, I do not have any liabilities. Which also translates to the fact that my investment strategy will not work for everyone. And a lot of things you heard online or seen online, please take it with a pinch of salt. So with that in mind, I'll just like to address two main concerns. One, it's about portfolio diversification, and number two, about investing in China. So let's talk about portfolio diversification first. So just an update from that video, for those of you who do not know, I'm actually catching the falling knife and I've been buying the dip on Alibaba. I'll buy not very aggressive because I've been depleting my cash pile. My current overall strategy for my portfolio right now is to really accumulate more cash and to build back up my cash pile, because I've been constantly buying the dip when it has been dipping from 200 to 180 to 160 to now in the 150 range. I've been constantly nibbling at it. I haven't been buying a lot because I really just wanted to conserve more cash and be more ready for any kinds of black swan event. And I can tell you that my cash pile, it's sitting at around 5 to 10%, which is dangerously low, and I'm aware of that fact. So I have been going a lot easier in terms of my buying, and I've been just buying the dip as and when. And from then, from that previous video until now, currently my Alibaba position works out to around 65% to 70% of my entire portfolio, depending on whether Alibaba is at 145 or 155. So of course, there were multiple comments, actually an entire barrage of comments telling me that, hey, young man, you should start diversifying away your portfolio. I think you have too much China exposure. I think you have too much exposure to one particular stock. What happens if your entire thesis don't play out? What happens if CCP wants to nationalize Alibaba? Your entire investment is going to vanish into thin air. Of course, I understand. And I really thank a lot of you from the bottom of my heart about being so concerned about my exposure and being so concerned about my diversification strategy. But let me just set two records straight. Number one, I'm so overly exposed to China because of my own investment thesis. For those of you who want to check it out, I'll leave the thumbnail of that particular video here. My entire thesis has not changed. Regardless of the crackdown, regardless of the regulation, regardless of the Evergrande thing, a lot of these seem to be noise to me. So if you were to look back at my diversification strategy, yes, I do acknowledge the fact that 65% is a very concentrated bet. And to some, and if not to most of the people out there, you cannot be sleeping well at night. But I would just like to qualify that, hey, my entire portfolio right now is around 20 odd grand. I really bought into the idea that, like the stock market, a lot of our investment decisions are driven by our outlook and optimism about our own life. And as very sophisticated investors, you know, companies like Apple, Microsoft, Tesla, a lot of all these companies command a very high premium because of the outlook and optimism of that particular company. And it's exactly the same for me as an individual investor. My outlook and optimism for China is pretty insane. And I would dare say that my optimism for China is a lot higher compared to the normal investors, which is also why I decided to have a huge proportion of my investment dedicated to the China exposure. And secondly, about my outlook and optimism about my personal life. So if you were to really look at it, 20,000 is not a very small amount, but it's not technically a very big amount either. My portfolio isn't really a portfolio ready for retirement, and it's really not a portfolio for me to get anywhere in life. And one more fact that you have to take into account is that I'm currently still studying in university. And as you all know, universities like to do surveys, understanding how much is the average undergrad pay and stuff like that. So if you were to really take everything into account, an entire 20,000 portfolio isn't necessarily end of the world if I were to lose everything. So which is also why I can be a lot more aggressive, a lot more contrarian, and a lot more concentrated in terms of my investment based on my own investment thesis. And of course, I would just like to throw in the fact that if you intend to do what other people are doing, don't expect a different result. And for those of you who are comfortable experiencing the volatility of up 20% or down 20% yearly, you can definitely invest in the S&P 500 or just a broad-based market ETF. But if you want to experience a much higher upside, stock picking is inevitable. Of course, I know that there is the risk of the company going default. There's the risk that the company fail. There's the risk that, hey, the government might even nationalize some of these companies. Of course, which is also why you need to be comfortable with experiencing a greater amount of volatility. Your maximum downside is a negative 100%. You lose everything you put into the market. But your upside, if my thesis do play out in 8 years, it's a 5x return. And if you were to really study a lot of all these hedge fund managers or study people that attempt to beat the market, a lot of them do take concentrated bets. You don't win investors' confidence by staying diversified. If you're just buying S&P 500 or you're just buying a normal ETF, what's the point of having investors parking their money with all these hedge fund investors? On top of that, they have to pay even more management fees for all these hedge fund investors. So in this case, you want to generate alpha or superior returns, you cannot be doing what the market is doing. So which is also why I have the responsibility when I'm putting myself out there on the internet to actually understand what I'm talking about and to have a proper and more nuanced approach when it comes to talking about a particular company and Alibaba in this case. So I hope that I did address about this entire diversification problem. And on top of that, of course, you guys might say that, hey, because you're 23 now, you might take a different investment strategy at 33, at 43 or at 53. And of course, I fundamentally agree. When at 53, you might be more risk averse. You might even start looking at asset allocation, start buying bonds, etc, etc. But I'm just trying to say, at different points in life, you should have different priorities. And right now, in this current stage of life, I'm more interested in capital appreciation, and I don't mind taking on bigger amount of risk to experience a greater amount of volatility. I think at the end of the day, you really need to understand your own personality, you need to understand your own temperament as an investor, and you need to understand your own risk profile. So for those of you who are extremely uncomfortable, even at 20 years old, you don't want to experience huge amount of volatility, nobody is stopping you from buying an ETF. Just go ahead and just participate in the market's movement. I'm not convincing you to do otherwise. But I would like to thank all of you again for your heartfelt concern. I would just like to say, We are in different stages and we can adopt a different strategy. And the bottom line is you have to sleep well at night. And if you are constantly worried about your portfolio to the extent that you can't even have a good night rest, I think you're overexposed. So that's all I have to say for diversification. And on the second point, am I really afraid about China nationalizing all their companies, how the Chinese Communist Party will overtake the entire country, how they want to take over, control, and don't want billionaires and don't want especially foreign investors to earn money? Of course, I have a minimum level of concern, but really, I always like to say conviction cannot be borrowed. And I really liked a very short excerpt from Peter Lynch, which is one of the legendary investors out there. You can buy a stock for $10. It's good if the stock actually appreciates to $12 or $15. That's when you have the opportunity to realize any form of gains. But what happens if the stock drops to $9, $8, $7, sometimes even to $5, $3, $2? What are you supposed to do as an investor? Are you supposed to panic sell? Or are you supposed to buy the dip? I think this is a very important concept. A lot of us always look at the upside. We always think about, hey, how much am I able to profit from this investment? Am I able to find a 2-bagger, 3-bagger, or even a 10-bagger? But many of us are disillusioned to the fact that what happens if our investment loses money? Or what happens if our theses do not play out? Do we continue holding the bag? Do we realize the losses? Do we move on? Or do we continue buying the dip? I think conviction, doing particular research in the companies that you own, and especially having the conviction to ride it through and to not do anything to your particular stock portfolio really commands a very high premium in the market, which is also why it's a very highly sought after and a highly valued skill. And it also differentiates a good investor and a mediocre investor. In order for something like a 10-bagger to happen, you have to hold the stock until it appreciates 10 times. For someone who always tries to time the difference, whenever there's a 20 or 50% appreciation, people start exceeding their position, thinking that they are the investment god or thinking that they're the messiah for investing. I think it really takes time for you to really understand what you're buying into. It takes knowledge and it takes research to understand what you're getting yourself into. And which is also why, for those of you who are extremely busy professionals, you have a full-time job out there, for those of you who are working in, for those of you who are doing 996, you don't have time to do the research and whatever, and you just want to stay invested, please go and buy an ETF. Even the investing legend Warren Buffett tells people to not buy into Berkshire Hathaway, which is his own fund, mind you. He just told the normal layman investor to just buy an ETF or buy the S&P 500 and don't bet against America. And for a lot of you out there, I would also promote the same strategy. But for those of you who want to follow me in this journey about understanding and about having a greater appreciation for China's equity and in particular Alibaba stock, then I hope that you come in with an open heart but still take everything that I say with a pinch of salt. Do your own due diligence, and I'll see you in the next video, but more importantly, I'll see you on the moon. Goodbye!